So what are the rules of a 1031 tax-deferred exchange? We're going to show you what you need to know and why you need to know it, because it's how most wealthy people build wealth in real estate. In this video, you're going to learn some of the rules and some of the terms that are used, as well as the specific laws related to and timelines related to 1031 exchanges. I'm also going to tell you a story about a 1031 exchange of how I saved almost $250,000 in taxes by selling a building and rolling $1 million into an oceanfront home in Hawaii and another apartment building. So stay with me, here we go. Okay, so wealth building with a 1031 tax-deferred exchange comes down to the idea of taking one property and selling it and buying another property. And instead of you taking the cash from the first property and putting it in your pocket, you actually put it with an intermediary who holds the money and helps you to get the next property. So let's talk about the terms. I've written them right here behind me. First of all, tax code 1031 is why 1031 is called that. It's section 1031 in the tax code, okay? So that is why it's called a 1031. A qualified intermediary is an individual who is licensed and qualified, meaning they are certified in doing 1031 exchanges. And the word intermediary means basically to assist from one party to the other party to have a relationship. You could think of this as a bridge between one party, in this case, one property to the other property, and bridging the gap and helping fulfill the movement of cash from one property to the other property. The role of the qualified intermediary is to assist you when you sell your property to do all the right paperwork to get the next property. If I own a property as Paul Maguire and I sell it, the next property must be in the title of Paul Maguire. So I can't take an LLC, say ABC LLC, and trade into a property and put it under the title of Paul Maguire. They must be the same. A trade or an exchange is real estate for real estate. So it could be land for a commercial building. It could be land for a home. It could be homes for an apartment. It could be a retail building for an apartment. Real estate for real estate is the main rule. So let's talk about depreciation. Depreciation means basically over time, you are decreasing the value of your property because it's getting worn out. Much like a new car, it depreciates over time with wear and tear. The government uses the same logic in a property. A brand new property has less wear and tear than a 30-year-old property. So the government and the tax code allows you to depreciate or take a percentage of value of that property and deduct it as an expense annually. For residential properties, that's 27 and a half years. For commercial properties, most cases, it's 31 years. Check with your tax accountant and your tax attorney on these things. Again, this is for informational purposes only. And when you're doing an exchange, you want to make sure you have a qualified licensed intermediary to assist you. You can't use a friend, a brother, or even an escrow company unless they're a qualified intermediary for a 1031 tax-deferred exchange. Like-kind property means real estate for real estate, like we talked about, but it also means that you can't sell your real estate and do a business. It has to be real estate for real estate, okay? Residential income, rental property for rental property, right? You can't take your house that's not rental property that you live in or exchange your equity out for a rental property. That won't work. It has to be rental property with the intention of investment for rental property with the investment or intention of investment. It could be land held for investment, traded into a commercial building, or traded into different land, okay? So real estate for real estate with the intention of keeping it as an investment. And by the way, don't forget to subscribe right here so I can help you with your real estate investing and understanding the different opportunities that are available through doing 1031 exchanges, which we're going to talk a lot about in the next few videos. Okay, let's talk about the rules. The three main rules of 1031 exchanges are this. When you sell a property, you have to identify a different property that you're going to buy within 45 days. It's called the 45-day rule. You can pick up to 3 properties, okay? So 45 days after you sell your first property, 45 days, you then can identify 1, 2, or 3 properties, and then you have to close escrow on them within 180 days. So the first 45 days, and then 180 days to close, okay? The 3 property rule says that you can identify up to 3 properties that you're going to buy, and you have to close on at least 1. Now, this is important, of greater or equal value. So in order to defer taxes on your exchange, you want to make sure that the property you sell and the property you buy have a difference in value. The property you buy, you want it to be greater or equal to the one you sold. So let me give you an example. I sell a house for $300,000 and now I'm going to buy a house for $400,000. It's greater, right? If I sold a house for $300,000 and I buy a house for $200,000, that's not going to work because the property I'm buying is less than the one I've sold or relinquished, also called the down leg. The property I'm buying or acquiring, also called the up leg. We want to make sure that when you do this, you get a property of equal or greater value when you trade. By the way, don't forget to subscribe. I'm going to tell you a story right here, right now about how I saved over $250,000 in taxes by doing an exchange right after this. So years ago, one of my first 1031 exchange deals was I bought several homes in the San Francisco Bay Area, and I had been renting them for a period of time, a little over a year, and values have gone up and I had fixed them. And what I did was I sold a couple of these properties, these homes, actually 4 of them, all within a short period of time, and identified an apartment building that I was going to buy. The apartment building was about $1.8 million, and I put around $400,000 or $500,000 down from the proceeds of these homes. I used a qualified intermediary, so all of the money from those sales went into the qualified intermediary. I met the timelines, I identified within 45 days, and I closed within 180 days. And I bought a 20-unit apartment building for about $1.8 million. That apartment building I held for a couple of years and I did improvements. I painted it, I fixed the elevator, I fixed the driveway, I redid the asphalt where it was damaged, and then where the trash truck came in and tore apart the driveway off, and I put in concrete, which still today is still there. Well, after about 2 years, I decided to sell, and I listed the property on LoopNet for $2.7 million, and it set for a while because it was a high price. Well, finally it sold. I got an offer for almost full price from an architect, and he bought that property, and I took my money and I bought another apartment building, a 23-unit apartment building, and 2 condominiums in Hawaii. So those condominiums I rented, okay, as rental property on the ocean, and the apartment building, which this was back in the early 2000s, I still own it today. Today, that apartment building kicks off about $15,000 a month in income, and the condo I no longer have. I got rid of that. But at the end of the day, when you do an exchange, it allows you to take a lot of money and buy other properties. Now, I normally, if I just took the cash, would have paid about $250,000 to $300,000 in taxes, because this was in California. So we have federal capital gains tax and then state capital gains tax. So by exchanging, I deferred $250,000 to $300,000 in taxes. What you'll learn in the next video is actually what happens when you do a 1031 exchange in terms of taxes and in terms of your ability to build your wealth and grow your portfolio. Because the more properties you can own, as appreciation rises over time, you can end up with a lot of equity built up. Again, talk to your tax attorney and the 1031 intermediary, because these laws are changing and can change, but this is the way it is currently. And always get advice when you're doing a 1031, because this is a lot of money and there's a lot of things you want to do. It's not that complicated, but you want to make sure you follow the rules so you don't have a problem later and have to pay taxes because you made a mistake, like with the 45-day rule or the 180-day rule, or you didn't do something else correct. So when you decide to do a 1031, now that you know the rules, follow me and you'll see what happens in the next video. When you do a 1031, what exactly transpires and what goes on, so you know the mechanics of it.